Okay, good evening, guys. Welcome to another live trading session with me, Steve Ruffley. We'll kick off a couple of minutes early just to get through the slide and the risk warning, all that kind of stuff, because we've got a few things to talk about before this key announcement today. So before I start, as always, the risk warning: remember that spread betting and CFD trading can highly risk your capital and can result in losses that exceed your initial deposit. To make it suitable for everyone, so please ensure you fully understand the risks involved. The information provided herein, under all circumstances, are an offer solicitation to invest. Nothing here should be construed investment advice. The information provided is believed to be accurate. The data is produced. Educational only. Content of webinars, personal opinion from moderator on intro.com. Content does not constitute financial investment or tax advice. Intro.com does not accept any liability for the content of comments made during this session. So we're going to go over some live charting analysis. We'll go through some of the early market movements that might be a bit of a precursor to what the markets are thinking. Multiple time frame trading, only really kind of applicable if we're looking for the longer term trend. We're going to look at the hourlies today because that'll give us an idea of what's trying to be achieved before this meeting. Fundamental analysis, what we expect to hear or not hear, more importantly, from Janet Yellen and the Fed. And I'll be trading my proper live real big money account today. So yeah, we're going to be doing something for sure if the markets are busy, and I cannot see how they won't be. So any questions and answers, all that kind of stuff, let's get it out of the way now before we get down to the nitty gritty of what's being done. So remember, you've got the chat window and the Q&A window. So anything you do want to ask, put it into there and we'll address it before the announcement is made. Now, we've seen a bit of a sell-off towards the top of the indices. So we see the S&P really is trying to get back to this nice daily trend line. So there's a nice daily trend line where we've touched the bottoms. I was doing some presentations for on FX Street and I was cycling through the different products. And I'd said that it was likely that the European markets would drag the S&P down to these lower trend levels. And it did, because we were trading much higher in the American markets than the European. But subsequently, we've bounced off towards these lower trend lines again, but we're still very, very bullish. I mean, the reason for why the markets are so high is for this reason why we're here today, because of the interest rate announcement. That while there are low interest rates, and by that is that free money still available, people are piling out of cash, putting it into indices, putting it into stocks, because you get some sort of dividend return and you get some sort of bang for your buck. So that is the only real reason why every time we've tried to correct and sell from indices, the markets have bought back up with that free money that's out there. But depending on what is said today, this afternoon, well, this evening, Janet Yellen and the Fed stance to interest rates, are going to be changed. It just came on the news today that, the Bank of England have said interest rates are going to move and it's going to be sooner than people may have anticipated. I've been saying this for literally the last 18 months, that I thought certainly the UK were going to be first out of the G8 to move an interest rate. It turns out it's looking like it's going to be the US, but the UK will not be far behind. We might be talking, literally, a quarter after. So interest rates are going to go up in the UK and the US. It's absolutely set in stone now. It's certain. It's not if, it is when. And that's the big thing we're trying to find out today. Is it going to be this year? Is it going to be next quarter, or what? That is what the market's expecting. So when you see the S&P selling off, that could be on the back of, again, the fears in Greece, the fears of contagion, and the fact that the interest rates might go up earlier than the market anticipates in Q3 or Q4. And that just means, interest rates go up, markets finally start to take that as bad news. So these trend lines, these lower levels in the market, are what we're going to be looking for today. Basically, if Janet Yellen, for whatever reason, makes noises, no interest rate hikes this year, the S&P is going to hit 2112, 2118, and maybe 2125. It's going to absolutely rocket in the short term. If it's a noise that we're going to make a hike to interest rates sooner than people anticipated, which I don't know how soon it could be. I mean, literally, it could be, a surprise announcement, again, or it could be in the next meeting. We just don't know. Janet Yellen's been absolutely, as good as Ben Bernanke on giving no forward guidance. So when the markets do actually get that information that the interest rates are definitely going to rise, and we have that, that kind of almost exact quarter, and that's what we can kind of do really, then the market's going to go up. I mean, it's very difficult to say what's going to happen on this meeting today because nobody really knows. Again, it's very much all the rhetoric, all the language that we hear. Previously we were looking for them to remove the word patient. Now we're looking for, again, this absolute confirmation that they're purely data-driven. So yet again, we saw another stronger than expected non-farm payrolls. Markets, again, didn't react particularly positively to that news. Again, filtering through. that if we have good non-farm payroll data and the Fed are focusing on good data, then the better the data there is, the better the economy there is, the more likely we are to have an interest rate hike. Okay, but as I say, it's not that we think we're going to have an interest rate hike. We know we're going to have an interest rate hike. Absolutely certain. It's just a matter of when. So really right now what we're looking for is all these comments that have been made over the last kind of few statements and few weeks and months, from Janet Yellen and the other key Fed policymakers, are all to do with how much this data means. Again, I've always been talking over the last kind of, 18 months about moving out of that growth cycle and focusing more on the inflationary cycle. And that just means we're not so concerned about the growth figures anymore. We're more concerned about the inflation figures because we're more focused on when interest rates will go up and what the tightening policy will be. However, just that spanner in the works once again means that we can't solely focus on inflation anymore. We have to go off the growth figures because that's what the Fed are going off. So the Fed are going off data, pure data, to see how strong the economy is, to make their decision on whether they should hike interest rates or not. So it's a dual-edged sword. Good data, like they don't find payrolls, initial jobless, GDP, is actually bad data. Okay, for the markets, because the better that data is, the more likely interest rates are to go up quicker. Therefore, markets should go down. And when I say markets, I mean the S&P. So really, this sell-off could be anticipating that the language that's said after, what's been, kind of announced today, and we're not expecting a change. We're expecting interest rates unchanged today, but it's never been about that. For the first time, we've got the economic projections today, which could be another thing to spice up the movement in the market. So we're not just looking for the policy statement. We're also looking for this economic projections to see if anything's changed. The projections are really what the Fed see inflationary and growth-wise for the next 2 years. So if that starts to be very, very positive, from an economic standpoint, that's more likely that interest rates are going to rise and maybe rise quicker than the market expects. So what's going to happen today is, again, it's going to be more volatile than non-farm payroll. It's as simple as that. Okay, we've seen the dollar continue to strengthen, and that means that interest rates are more than certainly going to go up this year, in my opinion. Okay, so that's why we're seeing this dollar strength. So if we say that anything that's contrary to that, and it's Q1 2016, dollar will get destroyed after this meeting or in the next kind of few hours of trading. If again, we generally say that it's more likely that it's data dependent, as long as we get good data for the next non-farm payrolls, which is probably likely after these winter months, then again, I expect the dollar to rise. And even when it comes out and interest rate rises do happen in the US, the dollar will continue to strengthen because that's known. And then I don't think it'll be till later we see some big, profit taking in the dollar. Again, the dollar's got a long way to go to get back to previous highs in the dollar Japanese yen, for instance. So we've got all the way to 135. Okay, so the dollar is by no means spent yet. I think we could have another, easily 10,000 pips on the upside, for the dollar to go. And that again, every time we haven't closed this gap, we haven't after this consolidation looked back to close back into the range. So dollars going back to previous monthly highs. So 135 for me is inevitable by the end of the year because no massive interest rates go up in the next meeting or they go up quicker than the market expects. People are going to pile into the dollar because it's relatively known. It was known here, and that's where the speculation is. So you're not going to get real profit taking until we're up, to previously known key levels. So a long way to go in the dollar yen. So other markets, as I say, we could see a continued sell-off if we do hear that the Fed are more aggressive on their rate hiking policy. So the S&P could continue right down to these lower levels. It could definitely get below 2070 and certainly get down to maybe 2060. Again, a lot of key levels on the downside because the markets have been historically high. Gold's a bit of a tricky one today. Gold's bouncing off the lows because of the sell-off in the stock markets, I would presume, but I still anticipate gold's going to go lower. So I would just keep an eye on gold today and see what happens. It's going to be fairly wild, I would suspect. DAX towards the low, FTSE towards the low, SMI a little bit more red than the rest of the markets. So again, could be people moving out of more safe haven styled indices and a bit more kind of aggressive profit taking. Pound against the dollar, again, you're going to see anything that is negative for the US. You're going to see cable extend So certainly we can get up to these big levels of 158. So interest rates go up slower, pound goes up, interest rates go up better. We're going to see probably down to this level, I would say, down here at 1.54076. If the dollar strength continues, then the pound will really should get hit quite hard, and we should get down to these lower levels. So we could see a big move down. I could easily say, I think 260 ticks, it's quite a long way to go. But again, I've seen these FOMC minutes and, the subsequent interpretation move the markets much, much more than a 150 pip swings in these markets. Because as I said, right now, this is every bit as big, if not bigger, than the non-farm payroll. And the non-farm payroll was a bit of a damn squib, to be honest. We had that bet expected 280, well above the range. And, the markets did move around after the first kind of 15 minutes, half an hour. But it didn't do anything amazing, did it? So really, it's a tough one. So someone's just saying GBP, YSD. I don't even know what that means, but don't look at anything that's not dollar based. Okay, so the whole reason why we're trading this FOMC because we understand what it should mean to to the market. So everything positive sends the euro dollar down, sends cable down, sends the dollar Japanese yen up. Simple. Anything positive, Again, it's difficult for the indices, but anything that's actually means that interest rates may not move as quick as we think will send the stock markets back up. But again, if they are going to move quicker and more aggressively than people may have thought, then indices continue to go down. Okay, so it's that dual-edged kind of sword where no news isn't really on the cards today. Any news is big news, and any news that moves the markets, again, will be very, very violent because nobody really knows the true effect of what's going to happen when we start to increase rates. And it's not, as I keep saying, it's not now that it's not just inevitable. It's people are betting on that it's going to be sooner than we think or later than we think. So when you talk about these $4 trillion that's traded in the FX markets every day, you've got huge amounts of money being speculated on, this morning, this afternoon and this evening based upon what can happen in the next 3 months, 6 months, 12 months, not just what's going to happen right now. So right now we're seeing that bounce off the indices towards the low in the S&P. Gold's come back from the highs. DAX and FTSE are making a bit of a resurgence. Again, could be profit taking prior to this FOMC minutes and release, or it could be people taking the opposite view that actually data's not been. It's been good, but it's not been as amazing as we think. And there's going to be such, huge ramifications when interest rates go up globally that, the Fed might actually hold off as long as they can. So maybe it isn't until Q4 or maybe Q1 2016. And that's all speculation. I know as much as anybody else does. Okay? I know as much as Bloomberg, Reuters, anybody else you could speak to. I know just as much as them. And if they tell you they know exactly what's going to happen, they're lying because they do not know what's going to happen. Right, Janet Yellen and the Fed have been very, very guarded about what they've said, what they're trying to achieve, and again, they've almost bottled it once again, saying that interest rates are certainly going to rise, and then go and say it's data dependent. So we've had this toing and froing kind of cycle for the last 5 or 6 years where it's will they, won't they, will they, won't they. Well, we all know they will. It's just when, and that when, ladies and gentlemen, is coming anytime soon. Anytime soon. So for me, right now, what we've got to do is really kind of zoom out. So again, I'm going to stay on the hourly charts and I'm going to see any of these lines could be hit. I don't know what market's going to move. I don't know what the market's going to do, but I guarantee that it's going to be fast and it's going to be aggressive. Again, we don't necessarily know exactly what to pick out on. It's not that Janet Yellen's going to leave something out. It's more what she's hinting. We're trying to figure out if she's hinting that it's going to increase Q3, Q4. If it's anything contrary to that, if it isn't anything to do with this year, then the S&P rallies, all the indices rally, and the dollar goes down. Okay, that's what the market, in my opinion, is looking for. For Janet Yellen to say, you know what, we're data dependent, but we just don't think we've got enough data till maybe 2016. And in that case, there we go. We know something fairly solid. The dollar sells off and the indices come back from these lows. On the contrary, if Janet Yellen makes any noises that we're going to go and with this year, we're going to be firm, we're going to stick to our plan, data's good, the US is, go US, then the dollar absolutely rallies up to 124. Okay? Bang, through 124, up to 124 spot 988, and maybe 125, and then the indices maybe get really kind of hit heavily overnight. So again, I mean, as I said, I mean, before it's very difficult to understand what speculators are trying to achieve. I mean, you'd say from how the charts look now from a technical perspective, the majority of European indices in the S&P are towards the relative lows for the trading range. The dollar's towards the high. Cable's a little bit of an anomaly right here. I'm not quite sure why the pound's so strong, but again, could be an indication that people are betting that as soon as the interest rates are certain in the US, they're certainly going to go up in the UK as well. So maybe that's why we've got a bit more pound strength than we have in the euro. But right now, it's anybody's guess, guys. Anybody's guess. And that literally, we're going to say as many things as I can, as many things I hear over the squawk, try and give as much real-time information. But these markets, we do not want to be in for a long time. We want to pick them highs, pick them lows, get involved in a market that's moving, and really, be very, very careful. This will move. Very, very volatile, guys. Very volatile. Silver, no point trading silver. You might as well trade gold. But silver will move in the same way as gold will. But I'm not entirely sure what gold will do. It just has been so unreliable over the last few months. My only advice would be stay out of gold. So really, for me, keep your eye on the S&P, this chart here. Keep your eye on the dollar yen. Okay? And maybe the euro dollar. This L shape here is where we're looking. Okay? So I'm going to keep these pretty wide and see a move. I'm going to try and repeat as much as I can from the squawk. I'm trying to say it all as quick as I can. Okay? Under a minute now, guys. We're expecting unchanged, but it's anything from the economic projections or the monetary policy statement. Yeah? Any changes. Okay? Good luck, guys. Key Ryan cable. Ten seconds. Watch gold. Unchanged, watch gold. Policy unchanged. Watch the euro dollar. Inflation continues to run below target. Labour market slack has diminished. Positive, positive. Okay, watch the dollar. So that's a change from the last statement. Okay, keeping inline growth 2% for GDP. Positive. Downgraded the 2015 GDP. Okay, gold's just made that big spike down. It's going back up. Watch out on gold. Reversed in the euro dollar. Euro dollar big targets up here. Okay, so watch the euro dollar coming off now. Dollar coming off now. So as dollar comes off, gold will come up. So again, negative. Taking this negative from the markets. Okay, watch that dollar. Watch that dollar. Okay, so inflation fairly in line. Watch gold. Watch gold. So the euro dollar dropped and it's gone back up. Again, we saw that dollar try to make some new lows, but it's coming back up. Gold got to the 50%, a good level up there. Again, a little bit of positivity in the DAX, a little bit of no move in the SMI, positivity in the S&P more than anything. Okay, so all fairly innocuous data really here, guys. We've seen quite a technical move. In gold, 84 ticks, gone from the lows to the highs. But, again, S&P really making them highs and coming off. Dollar, euro dollar really gone back to the middle of the range. We did see that aggressive start to sell off in the dollar yen, but really stopped. The same in the pound. Pound went up and then came back down. All trading pretty much back towards the levels we were a little bit before this announcement. So nothing really kind of clear cut coming through. So the market's really just paring back. The S&P really is leading Europe, and we're seeing a little tiny bit of positivity. But really, we just watch gold. I mean, gold could be a good spike up to 118 spot 5. Okay, if that spikes up very, very quickly, that could be a potential sell. So again, remaining fairly strong in the S&P, and dollar weakness coming in now. Okay, so watch the dollar weakness. Watch the dollar potentially get back down to these lows at 123 spot 221. Any dollar lows will send gold up, potentially. So back to the 50% in the DAX nearly as a little test. Again, as the S&P starts to rally, the European markets really should follow. So we see slightly slower GDP in the short term, okay? So that again could figure that interest rates might not go up as aggressively as thought. So that's really dragging the S&P up, but it's also dragging gold up, okay? 2015 is when we think the first rate hike will be, okay? So that could be in Q3, Q4. Okay, so watch the euro dollar. Euro dollar's getting a bit off this. You know, it could break very, very quickly to 1.1386. So I'll be selling up there. We did have a quick break. You know, back towards these lower levels, the 50% fib at 123 spot 880 in the dollar Japanese yen. Again, getting a bid back in cable. The pound's looking strong once again. 1.58797 is where I could see that going to. So again, if we break higher in cable, we should see a break of these higher levels of 1.3041 in the euro dollar. But really, you know, again, every time the dollar's hitting these lows, getting back up. S&P still remains strong, I guess. You know, looking for that 100 mark. No real move in the European indices, SMI, DAX not really doing a great deal either. So again, why I said to focus on the US stuff. I think, you know, the pound's looking fairly strong here. Again, it's all that making noises that, you know, it is going to be 2015. And, you know, that really should bring strength back into the dollar. You know, it really should, because, you know, what we were looking for is Janet Yellen and the Fed to say anything contrary to that, that data was not as good. And we did have that revision down to the GDP, but I don't think that's strong enough to say that, you know, well, that's big enough to leave rates, you know, kind of unchanged, or you know, certainly not talk about rates until you know, before that Q1 2016. So dollar again is looking fairly weak here. So we've got these lows here at 123.687, and then 123.505, and then if any news low below that is going to be 123 spot 221. So really looking for some sort of spike movement. I'm looking for something interesting here, really, to be honest. Some big levels in the S&P might be a good sell. Not really seeing any kind of dramatic movement. Again, from this being one of the most important meetings of what we've expected, you know, for quite some time, you know, with the economic projections and policy statement, you know, again, after this good non-farm payrolls, we've not really kind of seen anything major. What we've seen is the markets push in the opposite direction and quickly retrace in both the pound and the euro dollar. But nothing really kind of carrying that momentum through to the markets. Always difficult when you're in this situation now, because you know as soon as you stop taking your focus away, you're going to see a big retracement or a big move. And really what I'm looking for is that quick spike, okay? I'm looking for the big institutions, the big players to push the market up and down, you know, in one direction to try and get people in, but then also get people out, and that turn and reverse. And I think that would happen round about 1.58797 in the pound. And certainly at these levels here at 1.13848 in the euro. From what I can hear, what I can interpret, from what that has basically come over, you know, the wires, essentially, you know, we're unchanged from our thinking. You know, basically the market is expecting a rate hike this year, which is what we've been expecting since, you know, Q1 and Q2. So not really anything new. So you expect the trend to continue, and the dollar was very, very strong. You expect that to continue. The indices were low, and they've certainly retraced that. So again, we're getting mixed signals from the market to see exactly what we think is going to happen. So really, just looking a little bit red in the European indices. So again, not really anything too major to focus on. But, you know, we are particularly high in the S&P now, so maybe that could be an idea that we could. And again, we're not high enough in the range for me to start selling the S&P. It doesn't seem like we've seen enough. I don't know, directional movement. We just haven't seen anything, you know, particularly juicy come through, you know, from big clips and big trades. So obviously we've got, you know, the monetary policy, and Janet Yellen's going to make a statement a little bit later on. There's going to be things that are going to be said. We've got Lagarde speaking in a conference in Brussels. So we've got more news coming over the wire. But I mean, really, I guess the comments are kind of secondary now. I mean, from all that I can really kind of summarize from what's been said is that data has been slightly revised down, but there's been no glitch. There's been nothing to change the opinion that interest rates are going to go up in 2015. So again, watch for this S&P getting to these tops. We could see a break up to 2110 spot 50, 2116 spot 95. The dollar is still towards the lows, and again, this good 50% technical retracement 123.880. Again, the more we start to hold below that, the more likely we are to continue that sell off and see some strength in the pound and the euro. So going a little bit green in the FTSE. Okay, we're still looking to punch through these highs, and again, we're looking for these highs here from the break of the Bollinger Band. So these could be big targets for the S&P up here. So we could see a quick breakthrough, of maybe another 120 ticks. Maybe I doubt we've got enough strength to get up, to these upper levels. But as I say, you don't know. The trend in the indices is up, isn't it? So if we've got free money guaranteed for another few months, then maybe people are just putting more and more money into the indices. So again, we're just towards the low in the dollar. No real movement in gold. Again, back to that midpoint in the range, that 84 tick spike. Again, watch this euro. If the euro breaks here at one spot 13041, big targets up here. So what we're saying is 15 of 17 officials expect interest rates to rise by the end of 2015. So again, this is what we're in. Well, these kind of things we're looking for. So it's almost guaranteed that interest rates go up this year. Almost guaranteed now. These officials are hardly ever wrong when it comes to these bigger picture things. So I mean, watch the euro now. Watch the euro as the dollar continues to weaken on that. Again, I mean, maybe this is profit taking because we're getting that confirmed idea that yes, interest rates, are most certainly going to move this year. So maybe, as we've seen that, quite aggressive move this morning, and then dragging the dollar up. Maybe it's just some institutional profit taking before, getting the retail traders out before we go back up. So I mean, it's almost like it's inevitable. So again, you have to be aware that the short-term manipulation that be done by banks, central banks, hedge funds, etc., etc. If everybody's thinking, well, if interest rates are certainly going to move this year, then of course you'll be buying the dollar. Okay, but if the dollar continues to go down, all the retail traders are getting out because you don't have a strong enough stop. So you're basically now, if you're trading the high, 76 ticks offside, so this can go certainly another 50 ticks and get the retail traders out before we see that institutional bounce. Because basically everyone in the entire world, from a credibility standpoint, is saying interest rates are going to rise this year. Okay, so that is all we can kind of do. So, the European markets should follow the S&P. But, again, unfortunately, the American markets are surging and, Europe's not doing very much. So what you've got to do is think longer term. Where's the market's going to move overnight? What's the market's going to do in the open? If the S&P closes around here, then you expect a positive start in Europe. But if it's not moving right now based upon US data, stay out. Okay, so we're just hitting them tops again in the euro dollar. So watch for any quick spikes, bags and bags and bags of levels up here. Okay, a long way for it to go still, but the dollar, Japanese yen hitting these lows now. So as I said, these are your targets, and 123 spot 221. If we break that, we're all the way down to 122 spot 4530. So, for whatever reason, again, this is probably more institutional for me, that everyone's going to pile in to go, well, the dollar's got to go up, so I'll buy as much dollar as I can and hold it overnight. And then in the short term, the market just mullers all the retail traders and gets them out. So, again, got these potential highs to be hit in the pound, 1 spot 5814, and above that at 1 spot 58787 could be, good selling points. Because, again, I think this is definitely an institutional squeeze. Because again, we've got a strong S&P and weak dollar, so not really kind of giving us the clearest outcome here. But as that dollar goes down, watch for the spikes up in gold. If we break that 50%, I would say gold could certainly get to these upper levels at 1188 spot 5, and then I would guess 1200 is the next kind of psychological round number. So looking a little bit weaker in the DAX, still fairly, again off the highs in the S&P. Sorry, on the FTSE and SMI. S&P really is kind of struggling to hold on to these highs. So really, we're just being pushed to the intraday extremes. Really, the markets are not spiking out. Nobody's making any huge bets. Nobody's getting out of any huge positions. The market is, very cagey right now. So Alexander's saying, why is it a big deal if rates rise, not 10%? Well, you got to think that, Alexander, there's more money in the world than there ever has been in history. Okay, so a quarter basis point. Okay, put it this way. Okay, why did Scotland say no to the referendum? They said no for the referendum because 1 in 4 people in Scotland could not afford their mortgage if interest rates went up by as much as 25 basis points. 1 in 4 people. How many people in the US do you think will not be able to meet their cost of living or their mortgage if interest rates go up by 0.25%? Yeah, a lot. Okay, and when you start these raising cycles, you don't just start, we start slowly, but it doesn't just finish. We might be raising rates now for the next 10 years. So interest rates could go up to 4%, 5%, 6%. They could go up to 10%. So what it is indicating that once it starts, it isn't going to stop for a long time. So yes, it's not a big deal right now if they go up by a quarter basis point, but it could be a big deal in a couple of years. If you've borrowed £1 million for your mortgage, okay, and you've still got 20 years to pay off, and interest rates could double, treble, quadruple in that time, you're not going to be quite as cocky then, are you? As a borrower. So that is the whole point. That it isn't just what's happening now. It's what's going to happen in the next 3, 6, 12 months and after that. Because once your interest rates go up, they're not coming down for at least 5 years. So it is a big deal. And that's why we're all sat around here watching it, because some of the biggest hedge fund managers in the world are watching what's happening and anticipating what's going to happen based upon what Janet Yellen and the Fed are saying. So these things are absolutely huge, massive in real terms. So again, watch for gold to spike above this 50%. We could see a jump up to 118.5. Pound again is looking strong. We know our target is up here. I'm very reluctant to buy into these spikes, okay? Because again, the dollar's so oversold now, and again, we'll remain that down until we get there to 123.507 and that 123.219. We're still, relatively. I'm going to be relatively uneasy longing it. So again, as that dollar continues to come off, watch for that break in gold, because that again is another institutional style trade that they use to get retail traders out. So again, very, very strong in the pound and the euro. Again, we're 15 minutes after, what's generally been said and released in the markets. So anything that was due to be reversed would have been done by now. So again, watch that dollar coming off towards the lows. And again, watch the euro, dollar and the pound. I'd be much happier selling up here. I don't want to buy the spike. I know it sounds crazy. I know where it could potentially go. But I'd rather average into these upper levels than buy into that strength. But that's just how I trade. Yeah, pedal fire, I'm with you 100%. It's hard for me to buy gold at any point, even though I'm exactly the same as you. I'm pretty bearish. But again, as that dollar weakens, then people will jump into gold just on a natural kind of value basis. So for me, Europe's not paying any attention to what's being said right now. Okay, the S&P remains, relatively towards the highs, but I wouldn't be, getting excited or selling up until 2120. So again, that 50% is a very, very big, strong level for me in gold. We've just, only stayed above it for a brief amount of time, and then we've looked to come low. So again, could be an opportunity to start selling the yellow metal and get back to 1179. But it's so difficult because every time you try and sell it, the market does, these really irrational spikes, very, very quickly. And gold's such an expensive product to trade that your tolerance to stay in gold is very, very finely based. It takes a brave man to kind of average in heavily to gold, and I've certainly made my money, but I'd have the odd punch on the chin, that's for sure. So just coming away slightly from the lows in the dollar, but again, nothing's had that spiked movement, nothing's had that bit of momentum that's come in and gave me any real confidence to kind of go with it or certainly against it. And as we remain towards the highs in the US, Europe's selling off now. We're looking to all lower in the DAX. So a nice big 100% retracement level down here below 108 to 1360. Looking to go a little bit negative in the FTSE, retracing any of that little fight. And again, it was nothing. There was not really any kind of real move in the FTSE. It was just, again, a knee-jerk reaction to that strength we saw in the in the S&P here. So again, gold is tantalizingly close to a sell because as that dollar starts to maybe retrace and get back to that 50% at 123,884, maybe we see gold just come off them highs and just chip down, back into the range because it hasn't really moved on a great deal, has it? Well, guys, I mean that is difficult. That's very very difficult to trade these announcements, as I say, because so much is on that knife edge of what is relevant right now, what's relevant in 3 6 months. We all know interest rates are going up and they're going to go up soon, but it's quantifying that soon. It's really difficult. Janet Yellen's been very guarded about saying anything, of significance to the market. And I think the main thing is because they're trying to give themselves out as many outs as they can. So if we suddenly come across the next non-farm payroll being a lot less than expected, then they've got every reason to keep stalling and stalling and stalling. But as we know, there's only so long and so far you can stall. So we broke up again in gold now. So watch that how it reacts on 1185 spot one. Because then we might see that quick spike and that jump through to 1186 and potentially to 1192. So that's what gold will be doing. These are institutional style moves. As dollars towards the low, what we'll see is gold will heavily spike up, get all the shorts out of gold, and then the dollar will chink back very quickly, and then gold will fall back down. So we've got comments coming through Yellen very, very soon. So basically, we're just waiting for anything, concrete to come through from Yellen. Is she going to say anything? Is she not? I mean, again, it's very difficult to think she's going to say anything because she's so guarded. So as I say, we can watch Janet Yellen now and Lagarde, two fairly, heavyweight hitters. But again, really, all we're waiting for is anything, contrary to be released to the markets, anything contrary to be released, from Yellen or Lagarde. I mean, yeah, again, I mean, watch, as the dollar ticks back, we're seeing gold towards the highs. So, again, what we're looking for is a spike. We're looking for big orders to go through, and that short squeeze in gold. And then again, as it gets to the highs, the dollar will chink back higher, and then as it does, gold will fall back down. You see it time and time and again. That's why your correlations are so key. But obviously, we're coming back in the S&P, going negative now in Europe, which will obviously potentially put a bid back into gold. So very difficult, because everything's moving fairly contrary. Moving away from them highs in the euro dollar, so we didn't make any attempts to get back to these big levels at 1.13790. And again, with all the problems with Greece and the default, the euro is not going to stay high for very long. That's for sure. Okay, Pan on Fire saying, are these moves likely to continue into the UK session tomorrow? 100%, yeah, 100%. I mean, what will happen is people will say, well, nothing's really happened, so I'm going to maybe just watch it for the next half an hour. And then when you wake up in the morning, gold's been up here and then down here. It's all about that patience, isn't it? We get so frustrated as traders that if it doesn't happen exactly when we want it in the quick term, then we just get out and we wait for another opportunity. Whereas, the market and the big boys, that's what they're paid to do. Be patient. So again, gold wigging around now, coming away from them highs. And again, as I say, we didn't see that big institutional spike, but as the dollar chips up and gets more expensive, the demand for gold starts to come down. So negativity, really the DAX has got every right to retrace this move we saw earlier on in the week and come back down. The news from Europe's not great. I don't think the prospects of a higher interest rate in America is going to do the European markets any favors. So again, no news means that the trend should continue, and the trend really has been down. Okay, I know we're in a massive bull move and have been for some time, but we're looking fairly negative and weak right now in the bigger time frames. So again, every right to hit these lows in the DAX and test these lower levels here. Okay, so no major levels. I've got no major levels. That's not right. Yeah, okay. Major levels are back then at 10,000. Okay, so really, we do start hitting low and below these levels here in the DAX. We could see, a serious sell-off. Really could. So gold away from that 50%, and again, we're back on the 50% of the dollar yen. So as dollar gets more expensive, gold again comes off. So it doesn't give you the confidence to kind of get involved, does it? Because you don't really want to be selling that 50% to make 14 pips, do you? You want to see that much quicker spike up and down and try and get the real extremes of the market and to come back. Yeah, absolutely, Joseph. Yeah, well pointed out. But again, it's all these things, isn't it? Again, it's easy to say, but as soon as you've missed it, it's very difficult to say, well, I wish I was short gold now, because I think the dollar's definitely going to go back up, because that was an institutional push down, because it's really telling that, okay, saying the Fed will stop at 2%. It, it, okay, that's something that's been said, speaking on CNBC by Gross, saying the Fed will stop at 2%. I don't really see how that's got any relevance to anything, but a nice random comment coming through. So really got a few minutes now before Yellen. So we could see people profit taking. We could see the markets really just flip and turn. You just don't know, do you? I mean, basically, I've not heard enough for me to be heavily aggressive either which way. All I can say is that really it looks like this year. So I would say they're going to leave it as late as they can. So Q4. Q4 is when the first interest rate hikes happen in the US. I don't expect any major changes in the US data. I don't expect any major changes in policy. So, really, what's going to change? You're talking about trying to stop, a battleship. You can't just stop it on a sixpence. These things are getting towards the end of the course, and we're slowing, and we're not quite there just yet, are we? So, just got a nice link through from Milan. Thanks for that. About from the Federal Reserve. So, if you do want to watch Yellen on that, that's fine. To be honest, what I do is I wait for it to be said on any kind of major news wire. I don't trade the initial what they say because you get too much of a lag on a spread betting platform. So what I wait for is it to come out a few seconds later on the news wires and be confirmed, and then trade that. Otherwise, you can always be top and tailed. So again, that's just another tip. I'm a professional trader, but I'm trading on a retail style platform. So again, I've not got direct market access. I don't have the speed that the guys in the city do. Okay, so let's just be a tiny bit patient and see if we can hit any major comments. Excuse me. Sorry, that was a really dry throat there. So gold again, just hovering around that 50%. The dollar again on its 50%. And that's what I do, all the time. I'm looking for these key moves, key Fibonacci levels, key points of interest, key points of value. So there's nothing really screaming out. Again, I just have to. I just have to say that, yeah, I think for me the dollar yen getting back to 124.988. That looks like the most reliable trade for me. Again, the euro and pound have both hit the highs, but are really kind of struggling. So what we can see is that big reversal, and all the institutions plow back in, make that red candle hourly green. Then as they do, pound comes down, euro comes down. And that would be what I'd expect. Because, I mean, again, everything that's been said, that's why the market's so difficult. Because when you hear something, the institutions have the power to hold markets, in a particular stance and make you think you're wrong for, 15 minutes, half an hour, 45 minutes, an hour. And that's like a lifetime when you're trading, especially if you're offside. But to an institutional trader, to a hedge fund manager, it's their bread and butter. That's what they do. But they're trading, £1 billion accounts, not, £100,000 accounts. Okay, guys, let's just give it 3 minutes to see if any major announcements come over the wires from Yellen or maybe even Lagarde. And what we're looking for is anything, again, confirming or counter confirming. So anything, again, that says rates are definitely going to go up this year, then I expect the dollar from these lows, even where we're trading now, to be bought back up quite aggressively. and then we see again go red in the pound and the euro. So again, you can always tell when the big institutions in because what you see is these big shifts in the candles. They jump, okay, and they jump because that's the volume of data coming through and the volumes of clip sizes coming through. So that's what I want to see. I want to see the markets jump around and get to these upper levels, and then that's where you have to be involved. So if you want to be selling gold, you want it to be jumping up here and be selling before you've even realised, and then because it'll jump back down to these lower levels. And again, the FOMC really is, all about the big boys. Retail traders have found it historically very difficult to trade the FOMC and to make any real kind of money. So that's why these sessions are so important because you have to understand that it really is, fundamental moves at their most important, much more important than a non-farm payroll, much more important, to the kind of money managers out there because these are not just, as Alexander pointed out, it's not a big deal. Well, if you've got $1 trillion invested then it is a big deal over the next, 2 years, 3 years, 5 years, 10 years, because the interest rates alone, again, think about US debt. If interest rates start to go up over the next 2 years, it could cost the US government another $2.9 trillion in loan repayments. Okay, that's not to be sniffed at, is it? 2.9 trillion. So yes, every quarter basis point hike is important, but it's not them individually. It's the bigger picture. It's how high will interest rates go and how quickly will they go. And it's once that dam is kind of broken and bursts, that it isn't coming back. And again, think about how long we've kept interest rates for low for, 5, 6, 7 years, artificially low. So when they go up, they're not artificial anymore. They could be, high for the next 20 years. Nobody knows. And I'm telling you, nobody knows. So let's wait for that half-hour point, and that's when we're expecting to hear the comments come through. So as I say, let's wait for anything big to come over the wires, and then we confirm. I mean, gold's jumping around a little bit now. So European indices all towards the low now. S&P still green, probably 50% of the range. Well, that hourly range of what we've seen. Dollar really fairly static, not doing a great deal. So I say, in my experience, we generally get a couple of comments fairly early on, and that'll be the next couple of minutes. And if anything key is said, it'll be picked on the wires. And that generally, they say the most important things first. But you can never tell. That's the whole point, isn't it? Every time Janet Yellen speaks, it's something new, isn't it? Something new, something more kind of, elaborate to make us doubt ourselves as traders. So I'm just going to check any Twitter feeds as well, because sometimes you get a little bit of a leak on Twitter. Again, it's not great Twitter for these kind of things. It's a little bit lagging, but you never know. You can get the odd gem now and again. So gold again, just pipping back from that 50%. Indices taking a little bit of a bid. Okay, so watch these indices. Watch the dollar. Okay, dollar's looking a little bit weaker again, guys. Keep your eye on that dollar. Again, watch these upper levels in the euro. Quick movement, that's what we're looking for, quick movement. Indices, again, look at that S&P, dragging them European markets now green. But gold, again, still back to that 50%. God, everything about me just wants to sell gold. So, but again, I mean, look at the FTSE. Every time it goes green, we're hesitating. We're not seeing these strong directional moves. We're not seeing any kind of real flow through, being put through the market. Like dollar, every time it ticks down, it ticks back up. But then the euro and the pound tick up. The S&P, again, looking to at these upper levels. So many levels for it on the high side. But, gold's not really kind of taking any kind of negativity from that. Hmm. So again, from the fundamentals which are meant to be driving the markets right now, very little to go off. Again, it seems to be absolutely, I would say, what the market expected. But from the technicals as well, we're not really getting any love. We're not getting any, strong enough movement in order to, warrant buying or selling. It's just everything is chipping up and chipping down. It's almost again like algos are purely in the markets right now. And with such thin volatility, it's very, very difficult to put a trade on. Especially if the market gaps, you can be caught out. Even by 2, 3, 4, 5 pips. And you're paying a huge amount of spread on that. So again, that's that constant movement of the dollar coming back up, gold pipping down. The dollar again looks a little bit weaker, gold goes back up. But we're not hitting any of these high or lows from the session. We're not getting any new people involved in the markets. The market's just ebbing and flowing between these support and resistance. Indices go green in Europe, they're back red. Gold hits at the lows, then back to that 50%. The dollar just doesn't know what it wants to do unless it's back at this region here and heading down. We're not seeing any continued direction. It's just a license to trade and get top and tailed. As soon as you get in, you get out and lose money. That's what these conditions are designed to do. We're not seeing them quick blips, them quick fundamental, them quick fundamental to me that I like to see, them quick block buying and selling actions within the markets. All right, guys. Well, listen, I haven't heard anything over the wires. I can't get anything over, my reliable sources to say one thing over another. I think for me, unless you're in a position and you're, very secure in that position, it's just a license to lose money now. It's probably best to say it's one of these events that has the opportunity to move the markets, and it certainly has moved the markets. That is for sure. But to be honest, we haven't seen anything major, have we? We've seen gold go down and spike back up 84 ticks. No real, major movement. We've seen the dollar continue to hold towards the lows, but we expect, with everything status quo, that it's going to get bought back up. Euro and pound should come away from the highs, and indices, well, we've seen the short-term trend is down. So again, I would expect that to continue. All right, guys, I don't see any opportunity really here, to be honest. So I'm not going to waste your time and continue just commentating on the market. It's too difficult to trade this right now. I would say check the markets again in half an hour. But if not, as said before, let's see how the European markets take this on the open in the morning. But really, for me, it's status quo. Interest rates are going to move in the US 2015, Q3 or Q4, and that means I would say probably Q4. Or early 2016 for UK interest rates, and the hand in hand. All right, guys, listen, thanks for your time. Thanks for listening in. You've got some good technical levels on the chart, so if you want to print screen that, then do. These levels will be good, particularly these lows in the dollar and the highs in gold. Anything else, get me on Twitter at Steve Ruffley. All right, guys, been an absolute pleasure. Thanks for your questions, and I will speak to you all very soon. Thank you, guys. Good evening.